To calculate GDP using the income approach, we're now going to look at the items that make up national income. And those are wages, rents, interest, and corporate profits. Then we have to make some statistical adjustments to account for differences in accounting methods. Beginning with wages, these include both the compensation of employees and also something we call proprietor's income. Compensation of employees includes all wages and salaries paid to employees. It also includes employer payments into the Social Security system and payments into private pension funds, healthcare, and other employee welfare type funds. It also includes an imputed value of vacation and sick time. Proprietor's income is simply income from small business. Rents include income received by households and businesses that supply property resources, and this can be anything from a rent house, an apartment complex, an office building, a warehouse. The income approach does use net rent, so it subtracts a figure for depreciation on the rental property from the gross rental income. Interest consists of the money paid by private businesses to the suppliers of money capitals. Simply, we're talking about loans here. It also includes interest on items such as savings accounts, CDs, and corporate bonds. Corporate profits are the earnings of the owners of corporations, and basically we break that down into three categories. We say that corporations can do three things with their profits. The first thing they can do, and this is the first thing we want them to do, is they can pay their taxes. Corporations have taxes levied on them, on their profits, just like individuals do, and those flow to the government. Then they can pay dividends, and these are the main part of corporate profits, and they're paid to the corporate stockholders, the owners of the corporations. Finally, we have undistributed corporate profits. These are profits that are retained by the corporation, not paid out in taxes, not paid out in dividends, and they're retained to be invested in new plants and equipment, and sometimes we also call these retained earnings. And the next thing we have to do is we have to make some adjustments. And the first adjustment we're going to make is we're going to make an adjustment for taxes. Why do we include taxes in our calculation of GDP using the income approach? Well, it's to help things match up to the expenditure approach. So think about the expenditure approach. In the expenditure approach, we're adding up all the money that's spent on goods and services. Now, suppose that a firm sells a product for $1, but the government imposes a 5% sales tax. The retailer is going to add that 5-cent sales tax onto the final price of the good and pass the tax along to the consumer. So the consumer is going to spend $1.05. But the income of the producer is only $1. So we've got spending of $1.05, income of $1. So we add those taxes back to the income approach to help that match up to the expenditure approach. Now there's a few other statistical adjustments we have to make the income approach match up to the expenditure approach. First, we have to make a distinction between national and domestic income. Now, we said we were starting out looking at national income. Well, national income includes the income of all Americans, whether it was earned in the United States or if they're living abroad. But since we know that GDP is a geographic measure, we really only want the income of Americans that was earned domestically. So we subtract what we call the net foreign factor income. This is the income earned by Americans living abroad or American-owned resources abroad to obtain domestic income. Now, there's another piece that's included in this. We also have to add back, and this is all part of that calculation that's part of the net foreign factor income. We have to add back the income earned by Americans living abroad, but we also need to subtract. We subtract the income earned by Americans living abroad, but we also have to add back the income earned by foreigners who are working here, because that's not going to be included in our national income, but they're working here and producing here, so we want to include that in our GDP. So both of those calculations are included in that net foreign factor income. The accountants also add a statistical discrepancy value to national income to make the income approach match the expenditure approach. And To some students, it seems like that's just a cheat, but really what's involved in making that statistical discrepancy adjustment is that there's different. It just accounts for different accounting methods. We have some different accounting methods, whether you're looking at expenditure or income, and so on the large scale, when you're looking at the entire economy, those differences tend to add up. So that's really what's behind that statistical discrepancy. I promise it's not a cheat. Finally, because the amount included in the expenditures approach that represents replacement capital or depreciation doesn't add to anyone's income, it's not included in national income, so it has to be added back to achieve balance with the expenditure approach. So those are the kinds of adjustments that we have to make. Again, here's a more of a graphical look for those of you who are more visual. Notice that we begin with national income, with our wages, rents, interest, and corporate profits. And then we start making our adjustments. First, we subtract the income earned from the rest of the world. Remember, that's the Americans living abroad. Then we have to add back the income earned by foreigners living within the geographic borders of the United States. So we add that back. So those two together, income earned from the rest of the world and income earned by the rest of the world, together gives us that net foreign factor income. We also add back those taxes because they're included in the purchase price when calculating the expenditure approach, but they don't show us up as profits to the producers. We add back that capital consumption allowance related to depreciation, and then there's our statistical discrepancy there as well. Finally, just wanted to mention a few other of these national accounts that are included in the textbook, because we are going to be talking about a couple of these a lot more as we go through the course. We've got net domestic product, and this refers back to the depreciation expense we've talked about a couple of times. By subtracting the consumption of fixed capital value, that depreciation from GDP, we get that net domestic product. So this measure represents truly new production and not any production that was to replace worn out or used up capital. We've also got another one that's not on this slide, but I want to mention it real quickly. It's the GNP, Gross National Product. Whereas GDP is a geographic measure, Gross National Product, GNP, is a citizenship measure. So GNP would include the production of all those Americans living abroad, and it would not want to include the production of foreigners who are living here. So it's a little bit different measure, and every once in a while you'll see that one reported. Then we've got personal income and disposable income. Want to mention these because we're going to be using disposable income a lot coming up. Personal income includes all income received, whether earned or unearned. And it's going to differ from national income because some income earned is not received. Remember those corporate profits? We said that corporate profits could go to pay their corporate taxes, or they could be retained, those undistributed corporate profits. Those two pieces of corporate profits do not go back to the owners of the corporation. So that's income that's earned but not received. And there's some income that's received but not earned. And we're talking about, when I say it's not earned, I don't mean it's not deserved. I mean it's just not related to current productive activity. So that's going to be those things like Social Security payments, unemployment benefits, other welfare payments. So that's received, but it's not associated with current productive activity. So to calculate personal income, we start with national income. We subtract the income earned but not received. That's corporate taxes and retained earnings. And we add back the income received but not earned. That's going to be those transfer payments and things like that. That gets us to personal income. Then once we have personal income, then the next step down is disposable income. Disposable income is also known as spendable income. It's what you have left to spend after taxes are taken out. So it is personal income minus personal taxes. This is the one, as I say, it's going to come up a lot in the next few chapters. So make sure that you are familiar with that one and kind of commit that one to memory, because it's going to come back to haunt you.